There are moments, aren't there, when you stand at the precipice of a financial decision, feeling the weight of the market's vastness pressing in. You've diligently built your portfolio, perhaps followed every conventional rule, yet a whisper of doubt persists. A quiet unease suggests that something fundamental might be missing, a hidden crack in the very foundation of your wealth strategies. This isn't just about the dizzying array of numbers or the fleeting headlines. It's about the deeper, often unseen, architecture of your financial future. It's about asset allocation, a term that sounds deceptively simple yet holds complex truths that can either secure your peace or silently erode your hard-earned capital. Warren Buffett, with his characteristic profound simplicity, once observed, risk comes from not knowing what you're doing. This isn't merely a caution against impulsive stock picks or chasing market fads. No, its deeper truth resonates at the very core of how we distribute our capital across different assets. We often believe we are diversified, that our portfolios are robust, like a ship built to weather any storm, its sails perfectly trimmed for the journey ahead. Yet, beneath this calm surface, many ostensibly diversified portfolios harbor hidden fault lines, subtle vulnerabilities that remain unseen until the market's true tests arrive. It's a frustration, isn't it, to feel you're doing everything right, only to sense a persistent gap between theoretical knowledge and the tangible security you seek. What if the very strategies you've embraced, the ones promising safety and growth, are unknowingly exposing you to risks you haven't even considered? We're not just talking about minor missteps, easily corrected. We're talking about profound, often ignored mistakes in asset allocation that can silently undermine even the most well-intentioned investment strategies. These aren't just academic errors. They are the why behind the gnawing uncertainty, the reason some portfolios appear solid on paper but falter when tested by the market's unpredictable currents. Today, we will unpack these hidden truths, demystifying the unseen forces that can make or break your journey towards sustainable wealth creation. It's time to move beyond the headlines and truly understand the deeper mechanisms at play, to challenge the consensus and find your genuine edge. There's a silent dread, isn't there? A creeping realization that the very stability you sought in your meticulously constructed portfolio might now be its greatest vulnerability. You built it, perhaps years ago, following the accepted wisdom of set it and forget it, believing it would simply cruise toward your financial horizon. Yet, the market, like the ocean, is never truly still. The world shifts, economies evolve, and suddenly, your once balanced allocation feels like a relic, misaligned with the prevailing winds, instilling a quiet fear of missed opportunities or, worse, unseen risks silently gathering strength. This is the dead hand of static allocation, a pervasive myth suggesting that a one-time fixed strategy, like the classic 60/40ths mix, remains optimal regardless of the economic regimes we navigate, the market cycles we endure, or even how our own financial goals transform over time. We cling to the comfort of a blueprint, forgetting that capital markets are not static structures but living, breathing ecosystems. They are dynamic, constantly recalibrating, and what offered diversification yesterday can offer very little solace tomorrow. The counterintuitive truth, often revealed only in moments of market stress, is that correlations are not static. Assets that appear to diversify beautifully in calm, prosperous times often converge, moving in lockstep during crises. That passive diversification, the one you trusted to cushion the falls, suddenly becomes actively risky precisely when you need its protection most. It's like believing two different types of wood will flow differently, only to find them both sinking when the storm truly hits. To truly transform this vulnerability into strength, we must embrace a regime-aware asset allocation. Imagine your portfolio not as a fixed blueprint, but as a ship navigating an ever-changing ocean. Without a vigilant captain constantly adjusting the sails and rudder to prevailing winds and currents, even the sturdiest vessel will inevitably drift off course or, in the face of a tempest, capsize. This means dynamically adjusting your portfolio based on key macroeconomic indicators, market volatility metrics, and fundamental shifts, drawing from the principles of adaptive portfolio management. Are you truly the vigilant captain of your financial vessel, or are you hoping the currents will always be kind? There's a subtle, unsettling feeling that can creep into your mind, isn't there? A cognitive dissonance when your carefully chosen asset allocation, despite all logical reasoning, underperforms. It forces you to confront an uncomfortable possibility that your seemingly rational decisions were not purely objective, data-driven analyses, but were, in fact, silently guided by irrational biases. This gnawing doubt can be profoundly unsettling, making you question the very foundation of your financial judgment. Consider the insidious error of anchoring bias, often disguised as prudence. You might find yourself clinging to past market peaks or the initial cost of an investment, allowing these figures to anchor your perception of an asset's value. This attachment, while feeling like caution, actually prevents rational rebalancing, making you ignore contradictory evidence about an asset's true intrinsic worth or the undeniable shifts in market conditions. It's like navigating navigating a ship by looking only at the last port, rather than using the current stars and currents. The uncomfortable truth is that many seemingly logical diversification choices are often rooted not in rigorous, risk-adjusted return analysis, but in a desire for emotional comfort. Perhaps it's an affinity for familiar local companies or the allure of a hot sector, rather than a clear, data-backed investment thesis. This emotional comfort can lead to a portfolio that feels safe but lacks the true resilience and strategic depth required for sustainable wealth. It leaves you vulnerable, as if you've built your house on what feels like solid ground, only to find it's merely packed sand. To truly heal this tendency, we can draw wisdom from minds like Daniel Kahneman. Imagine applying a pre-mortem analysis before making major allocation shifts. This isn't about predicting failure, but about deliberately imagining that a decision has already failed, then working backward to identify all the plausible reasons why. This forces a critical examination of potential failure points, institutionalizing a deliberate counter-biasing strategy to mitigate overconfidence and confirmation bias. Your mind, when making allocation decisions, is like a skilled but biased cartographer. It draws maps based on familiar routes and past experiences, often failing to chart the unseen treacherous territories or new, more efficient paths that rigorous data analysis reveals. Are you allowing your internal cartographer to lead you astray, or are you demanding a map drawn by truth? There's a gnawing suspicion, isn't there? A quiet distrust that can settle deep within when you consider the intricate machinery of the financial world. You've entrusted your wealth to structures designed to grow it, complex investment products, sophisticated funds, yet a part of you wonders if these very constructs might be subtly siphoning off your hard-earned capital. This feeling, a wounded financial confidence, stems from the opaque charges and misaligned incentives that often hide in plain sight, eroding not just your returns, but your peace of mind. A common distortion we often encounter is the belief that higher-cost, actively managed funds or structured products inherently offer superior asset allocation and risk management, somehow justifying their elevated expense ratios. We are led to believe that this premium buys us expertise, a secret sauce that passive strategies lack. Yet, empirical evidence, time and again, whispers a different truth, often suggesting otherwise. It's a comforting narrative, but one that can blind us to the silent erosion at play. The shattered expectation comes when you realize that even seemingly small fees, perhaps just 1 or 2%, when compounded relentlessly over decades, can decimate a significant portion of your long-term wealth. This isn't a minor inconvenience, it's a profound attack on your margin of safety, often outweighing any perceived alpha those higher fees promised. It's like a constant, unseen leak, where every drop, though tiny, contributes to a vast loss over time. To combat this, we must become forensic accountants of our own portfolios. This means dissecting the total expense ratio far beyond the headline number. We must identify the hidden costs, the trading fees, the bid-ask spreads, the performance fees that subtly erode your capital bit by bit. Your asset allocation is a vast reservoir of wealth, and hidden fees are invisible cracks in the dam. Each crack, seemingly insignificant alone, allows a constant, silent trickle of water to escape, eventually threatening to drain the entire basin, unnoticed until it's too late. Are you truly aware of every crack, or are you hoping the reservoir will always remain full? There's a deep-seated feeling of inadequacy, isn't there, when you grapple with the paradox of diversification? You hear the conventional wisdom, the relentless drumbeat of broad diversification, yet your mind is drawn to the legendary successes of concentrated value investors, figures like Warren Buffett and Benjamin Graham. This tension can lead to a real paralysis of choice, a feeling of not truly understanding optimal portfolio construction and the very nature of risk. How do you reconcile these two seemingly opposing paths to wealth? The pervasive myth is that diversification alone guarantees safety, regardless of the quality or correlation of the underlying assets. This often leads to what Peter Lynch so aptly called diversification, where you end up owning too many mediocre assets, spreading your capital so thin that it dilutes your best ideas and obscures true value. It's like scattering seeds indiscriminately across a vast field, hoping something will grow, rather than carefully planting only the most fertile ones in well-prepared soil. The shattered expectation, the critical truth we must confront, is that true risk doesn't primarily come from a concentrated portfolio of thoroughly analyzed, high-quality businesses with strong economic moats and a demonstrated track record. No, true risk comes from owning too many assets you don't understand, where ignorance becomes a far greater liability than focused conviction. This is where the wisdom of the masters truly shines, illuminating a path beyond superficial safety. To genuinely discern the underlying mechanisms of portfolio concentration, we can adopt a 3-step value investing technique inspired by Benjamin Graham's emphasis on a margin of safety and Warren Buffett's unwavering focus on his circle of competence. First, Engage in dequalitative analysis of business moats, truly understanding what gives a company its enduring competitive advantage. Second, demand rigorous valuation to ensure a significant margin of safety, buying at a price that offers protection against unforeseen challenges. And third, cultivate the profound behavioral discipline required to hold through market volatility, trusting your analysis when others succumb to fear or greed. Your asset allocation isn't a shotgun blast hoping to hit something, it's a sniper's precise aim. True power comes not from scattering your capital widely, but from focusing it on a few deeply understood targets where you have a demonstrable informational edge and a significant margin of safety. Are you truly aiming with precision, or are you simply hoping for a lucky shot? There's a subtle philosophical wound that many of us carry, isn't there? A frustration stemming from an incomplete financial education that often overlooks the profound interconnectedness of global markets. We are taught to analyze individual companies, to understand sector trends, yet rarely are we fully prepared for the seismic shifts of macroeconomic forces or the systemic risks that spreadsheets alone simply cannot capture. It leaves us feeling vulnerable, as if we've mastered the details of a single tree, but remain blind to the forest fire raging on the horizon. A common distortion, deeply ingrained, is the belief that historical volatility and correlation data derived from relatively benign market periods are sufficient for future risk assessment. We cling to these smooth curves and predictable patterns, ignoring the non-linear, often chaotic behavior of markets during true crises and the potential for sudden, dramatic regime shifts. This reliance on past tranquility can lull us into a false sense of security, much like trusting a calm sea to remain so, even as distant storm clouds gather. The shattered expectation, the stark reality, is that so-called black swan events are not always entirely unpredictable. Often, systemic vulnerabilities exist in plain sight, overlooked by mainstream analysis that prioritizes efficiency and optimization over true resilience and robustness. We focus on the engine's horsepower, perhaps, but forget to inspect the integrity of the bridge it must cross in a storm. These fault lines are there, waiting for the right pressure to reveal themselves, often when we least expect it. To truly fortify your portfolio, you need a macro-aware overlay for your asset allocation. This means consciously incorporating leading economic indicators, engaging in geopolitical risk assessments, and robust scenario planning for tail events. It's about drawing insights from the principles of macroeconomic analysis and comprehensive risk management, much like a seasoned architect who not only designs a beautiful building but also thoroughly understands the geological fault lines it's built upon. Your asset allocation is a building designed for stability, but if you only consider the weight of its internal structure and ignore the geological fault lines it's built upon, even the strongest design will crumble when the ground shakes, regardless of its internal integrity. Are you truly building on solid ground, or are you ignoring the tremors beneath your feet? We began this journey feeling the quiet unease, the subtle whisper that perhaps our financial foundations, though meticulously laid, harbored unseen vulnerabilities. We've walked through the landscape of hidden errors, not to instill fear, but to illuminate the path toward a deeper, more resilient understanding of wealth. As Benjamin Graham, the sagacious mentor to generations of investors, wisely reminded us, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. This profound principle, often applied to individual securities, extends with even greater resonance to the very architecture of our asset allocation. It's not merely about picking good assets, it's about constructing a robust framework, a sanctuary for our capital that can withstand the market's innate irrationality and the world's unpredictable currents. We have seen how the dead hand of static allocation can leave your portfolio adrift, a relic in a rapidly evolving market, bleeding you dry through inaction. We've unmasked the investor's shadow, those unconscious behavioral biases that subtly sabotage your otherwise rational decisions, leading you down paths of emotional comfort rather than data-driven truth. We peeled back the layers of the silent erosion, revealing how hidden fees, seemingly insignificant, can decimate your long-term wealth like invisible cracks in a dam. We confronted the paradox of safety, questioning whether you are truly diversified or merely diversified, scattering capital rather than focusing it with sniper-like precision. And finally, we looked beyond the spreadsheet, recognizing that your allocation must account for the grand, often overlooked, macro shocks and systemic fault lines that can shake the very ground beneath your financial edifice. Recognizing these hidden mistakes is not merely an intellectual exercise. It is the first, most crucial step toward true financial mastery. It is about cultivating an inner knowing, a profound intimacy with data-driven truth that allows you to move beyond the superficial echoes of conventional wisdom. This journey empowers you to construct truly resilient, wealth-compounding portfolios, not built on fleeting hopes or market noise, but on fundamental principles and rigorous analysis. This path asks for continuous continuous learning, an unwavering commitment to independent decision-making, and a quiet strength to challenge the consensus. These are your ultimate defenses against the market's inherent complexity. Are you ready to truly become the critical investor, to embrace the profound responsibility and profound freedom that comes from understanding the why behind every financial decision, creating not just wealth, but enduring peace?